Hello, in this screen show I'm going to talk about the important issue of the linkage between the strategy choices that a business makes and the financial performance that comes out of the successful delivery of that strategy. Now, this is a linkage which is really very important, but we've not really succeeded in making that connection over really many decades. So we're going to see if we can explain why that disconnect has come about and what we might do to fix it. So a place to start is by thinking about the answers that strategy has been trying to offer to management and investors for a really very long time. And those answers are typically to questions like, how can I find a strong position in my industry relative to other companies? How can I therefore get some competitive advantage over them? And if I manage to do that, then I can get more market share than they get, and I can be more profitable than they will be. Now, those might seem to be quite reasonable questions. The problem is that they're actually not quite right. They're the wrong questions, and if you ask the wrong questions, then you're unfortunately going to get the wrong answers. And it turns out that not even profitability is the right question to be asking for reasons I'll explain in just a moment. If we have a business that is following a strategy and delivering what it sets out to achieve, what does the successful result from that strategy look like? Well, the business in this chart appears to be struggling. It started back in 2000 with achieving a return on invested capital pretty near to 16%. In the early years of the decade, that went down, up a bit, and then down again, and settled out at somewhere around 8-9% for the years between 2005 and 2008. Then a recession came along and really devastated our return on invested capital before we were able to recover in 2010 to 2012 to a return of somewhere between 6 and 7%. This appears to say that this business is in real difficulties, and the trouble's been getting worse over a very long period of time. So if this business had had the same capital invested at the beginning, and if it had the same revenue on which it was generating a return all the way through that period, what would have happened to its actual profits? Now, in order to demonstrate this, I'm going to have to change the scale really quite substantially, because if it had maintained that return on invested capital on a constant size of business, this is what its actual profits would have done. What its actual profits did do were completely different, and the difference between those two lines is the growth, a very, very substantial growth in the sheer scale of the business. Much, much more revenue, much, much more capital employed, and much, much more in the way of cash profits being generated for investors. And we're measuring profit here as earnings before interest, tax and depreciation. That's effectively the operating cash flow of the business. So now this business doesn't look quite so unsuccessful, and you may be surprised to learn that this is the actual result for Ryanair, Europe's leading and most successful low-fare airline. And it's worth noting that if the business had stayed at the same scale as it was in 2000 and actually maintained that return on invested capital, that's what would have happened to its actual cash profits. Business is the same size, return on invested capital stays the same, no growth, then you've just got a flat profit line. But actually the company has done hugely better than that line shows, and it's very debatable whether that line was ever feasible anyway. It almost certainly could never have stayed at the same size and maintain that profitability, simply because of the much more intense competition in the industry over the last decade. So it's got that profit outcome by successfully and substantially growing the business and beating competitors on the way through, even at the cost of a fall in its return on invested capital. Now, of course, it's not quite as rosy a picture as that blue chart shows, because a lot of that cash has to be put back into buying more aircraft from year to year. So in terms of free cash flow, the cash flow that goes back to investors is not as attractive as that picture seems to show. But nevertheless, the business is pretty successful. Far more successful than pretty much anybody else in the industry, with the possible exception of EasyJet. So is this a struggling business? Well, no, it isn't. But if you think that strategy should be explaining return on invested capital, then this return on invested capital chart would appear to say that this business is struggling and getting worse. So if we use our strategy tools to tell us how to be more profitable, it looks like those strategy tools have been helping us answer actually the wrong question. So if profitability is the wrong question, what's the right question? Well, we've known for a long time where the value of a business and the value of its strategy comes from. And we know that from finance principles. This has been axiomatic to finance since at least the 1970s. And the value of a business, the value of its strategy, the value of any significant initiative that the business takes is simply given by the net present value of discounted future cash flows. There's all kinds of sources that will explain this for you. If you want an explanation that the average person in the street could understand, then there's a very good explanation of the importance of free cash flow in the 2004 Amazon.com annual report. If you want a slightly more technical how to do it explanation, then Tim Collar and colleagues at McKinsey have laid this out pretty well in a book called Valuation from Wiley. Just as an aside, it's worth mentioning that although non-business cases, like public services or voluntary organisations, although those do not focus on profit growth or future cash flows, they do still need to be cash flow viable. So the answer we want from strategy then is not these questions of position or competitive advantage or market share or profitability. Management want to know how cash flow will grow. You can't ignore profitability if you don't generate profits from your revenue in order to invest in the growth of capital and other resources that you need to be successful in the future. Then you're not going to succeed either. So you've either got to be profitable or appear to be very likely to be profitable in order to get the backing from investors and the banks and so on to allow you to grow that cash flow. But that's not the answer on which we should be focusing. Cash flow should be the focus. Now, I've tried to explain a little bit more about how strategy has come to have this disconnect with the interests of management and investors in this book, which you can get on Amazon and Kindle, called The Trouble with Strategy. So if management don't get the answer they want from the strategy field, who do they ask? Well, they probably ask finance, but in many cases that can turn out to be a bit of a bad idea. This is something of a caricature, but if we take the finance-driven message for strategy, it goes something like, what you've got to do is you've got to keep margins up, keep costs tight, and raise our profitability. So if you naively follow those instructions, what happens is you end up with two contrasting problems. They're really quite serious ones. The first one is that you end up strangling the ability of the business to actually grow and develop. Let me explain with a simple example how that might come about. Imagine you have a business with 10 salespeople, and the 10 salespeople are just enough to look after all your current customers and keep your business as it is, with the same revenue and the same costs and the same profits, really, from now and forever. And those 10 people account for 5% of your revenue. But in the market you serve, there are 10 times more customers you could win if you had more salespeople. So what you would like to do is have double the number of salespeople, so 20 instead of 10. That would allow you to win more customers, grow your revenue, grow your business, and grow your profits. Unfortunately, if you follow this guidance, finance says, terribly sorry, that means increasing our sales costs from 5% to 10% of revenue. You can't have that expenditure. Now, that's a rather simplistic illustration of the point, but some version of that happens all over the place in business. We don't spend enough on training. We don't spend enough on product development. We don't spend enough on customer support. All those kinds of things get held back and constrained and strangled by too much enthusiasm for this finance-driven approach to strategy. Now, you might think that at the least that this does is at least it keeps the business safe. But unfortunately, the second danger is it actually exposes the business to more risk, not less. So how does that come about? Well, if you have for a number of years been pulling back on your sales force, been reining back on your training budgets, not spending what you really ought to be spending on marketing to build your success in the marketplace, so that your business is failing to grow as it could have grown, and then something goes wrong, like a competitor comes along or like a recession hits you, you've got nothing to fall back on. You've got nothing else to cut because you've cut everything already. And if you do cut the business, then you cut back training still further, you cut back the number of people in customer support, or you cut back on your salespeople, or you cut back on the business administration support or the IT budget. What you risk doing is actually breaking the business system that is even sustaining the current revenue and the current profits you're getting at the moment. So those are two dangers if you basically give up on strategy and ask for finance to give you guidance on how to plan for the future instead. What this means is strategy really has to step up to the mark now and actually help management understand how to grow business strongly and sustainably and communicate with finance in order to show that this can be done in such a way as to grow revenues and to grow cash flows out into the future. So if we look at that profit history for Ryanair, then we've got three questions that we need to answer. We're just looking here at the last few years. That's the profit chart we looked at earlier, just focusing on the 2006 to 2012 period. First question we need to answer is, why did we get here? What happened over that period and previous years that has brought us to that point? That's important because it gives us information about how the system actually works. The next question we need to answer is, if we do nothing else, where will we likely go? If competitive conditions get tougher, if it gets more difficult to find more routes where we can fly people to, or any other difficulties confront us, the likelihood is that actually our profits could start going down and then continue to go down in future years. So the third question we want to answer is, okay, if that's where we could go, what do we have to change? What decisions do we have to make? How do we have to steer our strategy to generate that better future? At the top of the page here, we've got the headlines of the strategy, who we're going to serve, what we're going to serve them with, and how we're going to do it. At the bottom of the page, we've got the cash flow forecast, the cash flow projections about what's likely to happen going out into the future. And what we need to do is we need to get from the strategy at the top to the cash flow forecast at the bottom. And the thing that sits in the middle there is a time-phased action plan. It's not a complicated concept. It's a somewhat detailed list, but nevertheless a list of all the things that we have to do, how much we have to do them, when we have to do them, in all the functions of the business, and what outcomes we're likely to get from that. And importantly, we have to be able to adapt that action plan as events unfold, because they always will. Things never turn out quite as we expected. And this is not a once-a-year business plan review issue. We may have to adapt our time phase action plan every quarter or every month, or in some cases as often as once a week if things are happening really quickly. But that's what we need. We need a time phased action plan to translate the strategy into the outcomes that we want and to point us to the likely future cash flow that'll come from achieving that. What does that look like in the case of Ryanair? Well, on the right-hand side here, we've got that same chart of the profit history and the rather unfavourable future and the better future that we would like. On the left, we've got the headlines of its strategy. Who are they serving? They are serving the millions of travellers who are particularly focused on low-cost travel. What are they providing them with? Well, they're providing them with very low-price flights. But more than that, they're very reliable flights. They arrive on time with their baggage and they go to very large numbers of destinations. There's slightly more detail to what exactly it is Ryanair offers to its customers, but those are the key points. Now, how is it going to do it? Well, this particular airline focuses on finding very low cost or zero cost airports, which may be quite away from the cities that they serve, but nevertheless, because they're remote from the city, they're low cost or zero cost for the airline to fly to. They also have a policy of always using the latest, most efficient aircraft. That means they cut down on their maintenance costs, they're very reliable, they never break down, and they can fly with the highest fuel efficiency in the industry. And with fuel prices being what they are, that's a very important issue in this industry. And they do lots of other things to make sure that they are operating at the lowest possible cost that they can. So if that's the strategy on the left and the performance outcome on the right, what does that time-phased action plan in the middle need to cover? Well, it needs to cover really quite a lot of things. This company has to make decisions about what fares to charge, not just in general across the whole of its services, but on every route for every time of day. It needs to make decisions about what routes to add. The company is flying well over 1,000 different routes today, and every one of those routes is a decision that's been taken at some point in the past. The company decided to start flying from Milan to Barcelona at some point in the past, and that's a non-trivial decision. Sometimes routes turn out not to be as attractive as the company hoped, and routes have to be cut. On those routes that the company is flying, they have to make decisions about what frequency of service to offer. Do they fly several times a day between busy destinations? Or on less busy routes, do they fly maybe only a few times per week? But that's a decision taken on every route pretty much all of the time. It's not the kind of decision you change every day, but it's not left from one year to the next. They certainly change that decision from quarter to quarter. They've generated that growth in routes because they've added to the number of cities between which they fly those routes. And they're constantly on the lookout for additional cities which offer potential numbers of customers who might choose to fly with the services that they start offering. And around those cities, which new airports are they going to start up at? The company has to decide how many aircraft to buy, and of course how many to sell from period to period, what type of aircraft they're going to operate and what size those aircraft should be. And they also have continuous decisions to make about how many staff to hire. Staff are a significant cost here, so if you are a lowest cost operator, that's core to your strategy. The decision on exactly how many staff to hire, where they should be located, and so on is a very important decision for you. So that's just a part of the list of the decisions in the time-phased action plan that this particular company needs in order to translate that strategy on the left to the performance outcome on the right. If that's what we need to do, what help does strategy provide us with? Well, it does help us answer the questions on the far left. That's known as the strategic positioning or the business model of the organisation. But it offers nothing at all about either of those two other steps. You can't get a time-phased action plan out of standard strategy tools, and you can't get a profit or cash flow forecast out of that action plan from the same tools either. So if that's the problem, what might a solution look like? Well, the solution requires a working business model from which that time-phased action plan could be extracted. Now, this company probably doesn't need to do this because they've been doing their business very successfully for well over a decade, and they've got very well-rehearsed routines for making all of those decisions all of the time. But most businesses are not in that supremely strong position, and a model to help them do this will be very helpful. Let me just explain the charts on this diagram before we start building up the business model. In each of the charts, there's a blue portion of the timeline, and that blue section is what's actually happened to the numbers from 2006 to 2012. So in that top box, that is it's known as the stock of airports that the company operates. So that number of 159 is the number of airports that the airline was operating at the end of its 2012 financial year. The red portion of the line is how those numbers might develop going out to 2017. So the kinds of growth in resources that might underpin a successful increase in the company's revenues and profits. Now, the small charts to the left show the rate at which those resources have been added. So if we look at the number of airports, the company added quite a few airports in 2006 and 2007, actually closed one or two in 2008, and has added a few airports each year up to 2012. Going forward, we might anticipate that they will continue to add more airports at something like the rate of 11 or 12 per year. Now, if they do that, that will generate the increase in that time chart of the number of airports shown in the red line. Pretty much the same applies to aircraft. 300 aircraft today, 2012, and they bought 60 aircraft in the latest year, and the small chart shows the number of aircraft added in each of the prior years. The same once again for the number of staff. They're employing 8,390 staff, and in the latest year they added 1,020. Now, if they continue to add airports and aircraft and staff at the rate shown on the left, then they will grow to those numbers, the red numbers, in 2017. Why do they want to grow to those numbers? Because that's what they need to underpin the growth in demand and sales that they hope will come from an increase in customers. Now, the other thing they have to make decisions about is what fare they will charge. So up there at the top right is what's actually happened to the company's fares in recent years. And you can see there was one year where the company cut its fares really quite sharply. Now, it did that in the recession in order to sustain its customer volumes and its sales rate in the face of a big downturn in demand, and perhaps also to inflict some pain on its competitors. You remember that its profitability fell quite sharply in that year, and that's why. It fell because of the cut in fares, not because they lost customers or customers travelled less often with this particular airline. Now, that choice of fares clearly impacts on two things. First of all, it impacts on how often people fly. If it's cheaper to fly, people fly more often. If it's more expensive to fly, they fly less often. But the other thing it does is it wins you customers in the first place. If people see that this particular airline will fly you somewhere for 40 euros, then they might become your customer for the first time. So over on the left, we've got the growth in the number of customers, and that growth has arisen because of those choices that the company made about the price that it would charge, and also because we've been increasing the number of airports we serve. Every time you open a new airport in a city you weren't serving before, the people who live near that city can fly with you when they couldn't fly with you before. So if we continue with the plans outlined in the red portions of the charts here, we hope that we'll be able to build the number of customers to something like 26 million and the number of trips per year, something like 5 times per year. Now, the company doesn't actually report the numbers of customers and trips separately, but by reading between the lines and hearing the kinds of things they say, we can estimate that the current number of regular users of Ryanair is somewhere around 16 million, and the frequency of trips is somewhere around 4 to 5 times per year. But if you were inside the company, of course, you can actually do these numbers accurately and in some detail. Now, if all of that happens, then we get this customer base buying with this frequency, and the result of all that is that we generate this growth in the number of passenger journeys in the middle of this diagram here. The company flew 75.8 million passenger journeys in 2012, and if this projection of their plans turns out to be right, then that number would grow to 150 million by 2017. If that happens at the fare shown at the top, then the total revenue will grow as we're showing in the chart at the right. To make all that possible, we need the growth in the number of airports, aircraft and staff shown at lower left, and they account for the change in the total operating costs shown towards the lower part of the diagram. So if the revenue grows at that rate with no more than that increase in costs, then you end up with that result in terms of the company's profit growth, ending up at something like 2 billion per year. Now, of course, this is our external assessment of a plausible plan for this company. It's entirely possible that Ryanair itself has got different plans and different numbers. But you can see how the logic of the decisions that are being made come together to generate both an explanation for where we've got to today and a projection of where we could get to going out into the future. So that's an example from a particular company. In very general terms, here is the logic. Profit comes from revenue minus costs. Revenue comes from sales multiplied by price. If we are in a business where we've got bought-in costs of goods, then we may need to go through a gross profit calculation in the middle there, but that principle that basically works. Sales come from customers and the price they pay us for the goods or services they buy from us, and price affects whether we win customers or lose customers. We also win or lose customers depending on whether we have products that they want or we drop products, and if we do marketing to try to win those customers. We have to make sure we provide the number of staff and the amount of capacity necessary to fulfill those sales, but those things come at a cost, and that's the cost part of the income statement. And the balance between the demand coming from the customers and our ability to serve that demand determines, first of all, whether we fulfill those sales that we could capture, and secondly, whether we keep the customers that we've previously won with our price and our marketing and our product range. The example of this I just gave for Ryanair is just that. It's just an example. We could do this for any company. And the slightly concerning thing is that we've known the professional method to do this for pretty much 50 years. It's called system dynamics. It was developed at MIT. It is rigorous, fact-based, and it really handles this dynamic of performance over time and the connection between strategy and policy choices we make and the performance that comes out of that through a working model of how the business actually functions. Now, there's a very simple but unavoidable logic to all this. Profit is revenue minus costs. Revenue is sales multiplied by price. Sales come from customers. Sales do not come from market growth and market share. Customers drive sales. We have to have the staff and the capacity and make the decisions in order to support those customers and fulfill those sales, but those things drive the costs of the business, and the products, the marketing and sales effort and the price affect whether we win customers or lose them or not. And in the middle there, we have to make sure that supply and demand are sufficiently in balance that we fulfill the sales and keep our customers. So we can fix this disconnect. We can get from strategy to a time-phased action plan to a cash flow forecast. You think back to the diagram we showed on Ryanair, that was telling us how many aircraft to add quarter by quarter, how many airports to open quarter by quarter, how many staff to employ, what prices to set, how much marketing to spend out into the future. It's a rigorous and a practical method, and the good news is that pretty much anyone could do it if they just follow some simple principles and disciplines in putting these models together. To find out more about strategy dynamics, including an online course on how the method works and information for teachers who might want to teach about this, go have a look at our website at strategydynamics.com. There's also other information and a blog of mine at kimwarren.com. And there are a couple of books. There's a full textbook on the subject, Strategic Management Dynamics from Wiley, but there's also a Kindle ebook, Strategy Dynamics Essentials. If you want to know more about the issues that there are around the whole strategy field and why we've been struggling so badly to actually help management with these important decisions that they need to take, do take a look at the book, The Trouble with Strategy, which you'll find on Amazon. So thank you very much for listening to me, and we do hope to hear from you. If you go to strategydynamics.com, there's a lot of information there, but there's also a forum and there's a LinkedIn discussion group on strategy dynamics as well.